Hey guys, I want to walk you through an incredibly simple put credit spread strategy that can be used in the market right now today called the bullish play. Historically, it has a 76% win rate and an average annualized return of 53.62%. Outside of all the numbers, this strategy has even been back tested by a third party to prove that it consistently outperforms the market and will help you make money right now. So let me walk you through the exact strategy step by step, the criteria you want to look for to enter, and how to set up the trade. So this is coming from the free PDF that all you guys have since you're going through this course. It is linked right below these videos and you have access to it. Anyways, in this right here, it lays out the bullish play trading guide. So here are the entry rules for it. Hey guys, just want to hop in here real quick and let you know about a free training that I'm doing here very soon. If you click the link down below, you can access it and learn how I make $3,000 to $5,000 every single month using the new Mother Credit Spreads trading strategy. I'm going to walk you through it step by step. So by the end of the training, you'll walk through knowing how to actually implement it and use it for yourself. So you can risk $25 to make $25 with a 75% win rate. So if that is interesting to you, please make sure to click the link down below and save your spot. All right, enjoy the rest of this video. First, I'm going to walk through it, and then I'll display it on the stock chart so you can understand it. Okay, so stock price is greater than the 200-day moving average. We have a stock price that is less than 3 standard deviations of the 200-day moving average. We have the SMA being a 10 is greater than yesterday's SMA 10, and the stock price daily change is 0.1 or minus 0.15%. So all these numbers, blah, 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 fugazi, whatever. Let's talk about the actual way to implement this. Okay, so first off, if you have this indicator on your TradingView chart, which is completely free to do, you don't even need like to pay anything for this. I gave it to you for free, a part of this program. But once you have it, you can actually install this indicator here. But basically, this middle line is the 200-day moving average. So the first thing is the stock needs to be above this gray line. So if we're looking at it from a checkpoints thing, this is check true. Next, the stock price is less than 3 standard deviations of that moving average. Where exactly is that level? Well, if I go here to the settings, you can see that if I enable the standard deviation high-low, 3 standard deviations above is this yellow line. So I know that this trade is going to be good if it's above this gray line and below this yellow. This is my bullish momentum upward type of range. Okay. Next, the SMA 10 is greater than yesterday's 10. So this short-term trend right here, we're simply looking that today's value of the 10-period moving average is greater than yesterday's, essentially meaning that now it's trending up, right? Because if it's less than, then it's trending down. If it's more than, then it's trending up. And so right now it's a bit neutral, kind of trending down. So this doesn't really meet that criteria, but this is what you look for, okay? Next is the stock's daily price change has to be greater than minus 0.15%, aka we're not looking to buy on a major down move most of the times. We can buy on a down move, but not a major down move. Why? Because if we have a major down move, that's kind of signaling maybe a crash or furthering a crash. So again, if we have more than a minus 0.15% change on the day, then that trade is good. Once all those are met, that is the bullish trading criteria. Now again, all those are automatically shown on the credit spreads algo when it matches the setups and criteria for you. It will display it here with everything you need to know about how to enter the trade. But again, that is how you look for it yourself. So that is the first way we can enter with the bullish strategy. Now, once all this criteria is met, how do we structure the trade? So again, we're going to go out 9 days into the future. So we want to make sure that it lands on a Monday, Wednesday, or Friday though. So if we add 9 days to the current date for our expiration date, then we want to make sure that it ends on a Monday, Wednesday, or Friday. So for instance, today is October 5th. If I add 9 days, that becomes October 14th. 14th. And again, October 14th is a Wednesday, I believe. Should be Wednesday. Should be Wednesday if I get my dates correctly. So October 14th will be my expiration date, if I'm doing that correctly. Okay, next, again, we have percentages that we target, but just for easy math in general, we're looking to target a 25 delta. So we're looking to go 25 delta, which essentially means we're just going out pretty far from the stock price, roughly 1% away from the stock price, and we're going to enter a $1 wide trade. So that is kind of how we structure that. Again, this here is for some reason incorrect. I don't know why that's there. I will update that here in a second. But anyways, now for the recovering method. So you can see here that we can break the market down into uptrending here. And then also there's a period when the market gets down super low. It's now overextended, but to the bottom side, right? Like we've crashed too far that it's about time for a bounce. You can see here when it comes back below. And so that's what we're looking for here. When we cross this bottom yellow line, then we can start entering bullish plays again. Why? Because this period here is all bearish underneath the 200-day, but here this is all bearish. But if we can catch it below it, this is bullish when it's going to start bouncing, mathematically speaking. And so how we enter those trades is exactly the same here. Wait for price to be below that bottom yellow line, aka -3 standard deviations. We're going to have the same expiration where the current date plus 9 days round up to the next Monday, Wednesday, or Friday if it lands on a Tuesday, Thursday, or a weekend. We're going to target for this one the 35 delta, and so that's how we're going to put on this trade, and we're going to use a put credit spread trade. Again, I will have this all updated by the time this course is up. I'm sorry about these little mishaps here. Anyways, that is how we play the bullish play strategy in both bullish markets and recovering markets, and that combined, those two approaches together, gives us a 76% historical win rate and an annualized return of 54%. So if you want a more than 5x, even 6x, the average market return by only trading two strategies, or really one, then use this put credit spread trading strategy. Again, if you need help with anything, please let me know in the Discord group chat, and I will hopefully instantly respond to you or respond as quickly as I can. All right, guys, see you in the next lesson where we go over short play and call credit spread strategies.